So you got a multi-partner LLC. It's a popular structure because it offers liability protection and flexibility, but there's a common financial challenge buried in the accounting that many partners don't see until it becomes a real problem. Think of your business as a pie. Everyone believes they know their slice, but unclear bookkeeping can make it impossible to know for sure. It's not a matter if this will cause confusion, but when. And when it does, it can lead to financial disputes and damage the partnership. The good news is that you can address this issue before it escalates. These aren't just rookie mistakes. I see them in profitable, well-established businesses. They often start as a small oversight, then grow into significant issues that create financial uncertainty when you can't clearly tell who owns the slice of the pie. Today, I'm going to walk through the 4 biggest bookkeeping challenges for multi-partner LLCs. My name is Alex, and I'm a professional bookkeeper. I've worked with clients to get their bookkeeping in order to fix these errors before they become fallouts in the future. First is commingling equity accounts. The most common mistake is improper tracking of partner equity. Perhaps you're all putting it in owner's equity account, or owners contribute and owners distribute. And this can create confusion down the road. It's important to separate out these accounts. Here's the issue. You lose visibility on who owns what. It's like baking a pie by having each partner add ingredients to a single bowl without measuring. Let's say partner A contributes $60,000 in cash and partner B contributes $40,000 in equipment. If both amounts go to the same account, how do you determine which in a year's time? It becomes very difficult. The real challenge arises when it's time to make a major decision, like a partner buyout or calculating final balances for your K-1 for tax purposes. Without a clear record of each partner's ownership, there's no objective way to determine fair value. The solution is straightforward. You must maintain separate capital accounts or owner contribute and owner distribution accounts for every partner. Think of a capital account as the official record that tracks the precise size of each partner's slice of the pie. So here's how it would work. Partner A puts in $60,000 cash. The entry would debit cash $60,000 and credit the partner's capital $60,000. Partner B contributes $40,000 in equipment. You would debit that from the equipment account and then credit it to the capital account or the owner's contribute account for the partner B. From this point on, every transaction that affects ownership is tracked for each of these individual accounts, creating a clear record of each partner's stake in the business. Ignoring the operating agreement allocations is the second mistake. Mistake 2 is the inconsistent handling of money between partners in the business. One partner might add $10,000 to cover payroll, while another takes $5,000 for a personal expense. Without a strict process, these transactions can be missed and not recorded at all. This problem is amplified when everything is tracked in a single equity account. The key here is understanding the nature of this money. Is that $10,000 additional capital contribute that increases the partner's stake, or is it a loan to the business that must be repaid? Is that $5,000 withdrawal a formal distribution that reduces the partner's equity, or is it a draw that needs to reimburse the owner? When you don't document transactions properly, your capital accounts no longer reflect the true financial picture. The solution is to be diligent about documentation. Every dollar that moves needs a clear paper trail. When a partner adds funds, classify it immediately. If it's a capital contribute, credit their individual capital account. If it's a loan, you need a formal loan agreement and to record it as a liability on the books. When a partner takes cash, it must be recorded as a debit to their capital account, such as owner distribution, reducing their equity. This could only be done according to the rules for distributions. This discipline is what keeps your capital accounts accurate and trustworthy. The third mistake, having no rules for capital. Your business is growing, but cash flow is tight and you need money to fund a new project. This is when it might make a formal request for partners to contribute more funds. A bookkeeping challenge arises when this happens and you discover your operating agreement doesn't have a process for it. Here's a problem from a bookkeeping standpoint. You ask every partner to contribute an extra $20,000 and one partner can't. that other partners contribute. How is this recorded? Do the contributing partners now have a larger percentage of the company, or is there extra money alone that gets repaid first? Without pre-established rules, your bookkeeper has no guidance. Any method of recording the transaction could be seen as unfair to someone, and the financial records become a source of debate rather than a source of truth. This can stall progress and create serious friction. The solution here is to ensure your operating agreement addresses capital calls before you ever need one for your bookkeeper to do their job properly. If any of this sounds familiar or a bit overwhelming, that's understandable. This subject matter is complex, but getting your bookkeeping right is the bedrock of a healthy partnership. It's how you ensure fairness and clarity for everyone involved. If you're looking at your own books and want to ensure they're structured correctly, click the link in the description below to reach out to me and for a 30-minute consultation. These bookkeeping principles are guardrails that protect your investment and professional relationships. A multi-partner LLC can be an excellent vehicle for building wealth, but only when it's built on a foundation of sound financial management. When you maintain separate capital accounts, follow your operating agreement, document transactions, and plan for cash needs, you turn a challenge into a powerful, resilient business. Thanks for watching. Leave any comments below if this was helpful.